You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to the final 2023 episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me in the all-new OIC studios is my colleague, Roma Colwell, a 25-year options veteran with roles ranging from market maker and risk and portfolio manager, among others, as well as a fellow options instructor here at OIC. Roma, as always, welcome back. Happy holidays.
Thank you, Mark, and always happy to be here, and happy holidays to you and everybody else that's listening to our podcast today.
Excellent, Roma. Excellent, Roma. Thank you. I know that you're going to be presenting two upcoming OIC webinars in December, the first of which you're going to be talking about the differences between equity and index options, and the second you're going to spend some time looking at various volatility indices. So with that in mind, I wanted to use our time today to not only talk about your upcoming presentations and get a preview of what you're going to be discussing, but also take a look at the incredibly successful university outreach program that you've been spearheading. How does that sound?
Oh, that sounds awesome.
Okay, excellent. Roma, let's start with indices. And for what it's worth, I remember you and I sat down last year and we talked about the same topic here, and we were able to put to rest the fact that the correct verbiage is indices and not indexes when we're talking about the plural of an index. So we can put that aside. That being said, when it comes to index options, what are some of the ways in which they differ from equity or ETF options?
Yeah, so what I thought we would do is just concentrate on really three of these indices that are probably the most popular out there, and there are quite a few. But we're gonna, I'm going to contrast them against the ETF and how they work. But we'll start with the SPX, right? So the SPX Standard & Poor's 500. So it's broad-based, large-cap stocks for the most part. And then we have the other side of it, which is the SPY, the ETF, which is 1/10 of the SPX. Now, probably the remarkable part of these indexes and trading these indices is the fact that they settle in cash, right? So
Right.
they're European, so you can't exercise them before, but there really would be no reason to exercise them prior to expiration, but they do settle in cash, which translates to the fact that you will not lose your portfolio. So if we go back and think about a covered call and in the ETF or even in equity, and that call goes in the money, there's a huge chance that if you if you decide to let those options be assigned, you could lose the stock that you're holding. So since these indexes settle in cash, there's no potential way for you to lose your portfolio on them.
Right. You're meaning portfolios, meaning you're not going to lose the shares that you hold, but you're certainly going to lose cash.
Right.
So the difference when we talk about cash settled versus physical settled, an ETF or an equity, if you exercise or assign, it's going to be settling a physical exchange of shares. You're going to be selling stock to me. I'm going to be buying it, et cetera. With an index being cash settled, you're just paying out the intrinsic value, or you're collecting the intrinsic value of the contract if you exercise or get assigned, right?
Yeah, that is absolutely correct.
Okay.
So I think the another advantage is, of course, the tax treatment. Mm-hmm. So you have that 60-40 tax treatment that goes along with trading options on these indexes. So 60% is long-term tax treatment, 40% is a short-term tax treatment that you don't get with the ETFs when you're trading those.
Right. And obviously we should put a disclaimer. We're not tax advisors. Certainly contact your tax advisor or your trading firm or brokerage firm to get some information on the tax treatment. Not every index option has the same tax treatment, so definitely look into that contract. Mm-hmm. You had mentioned European settlement, European exercise, I should say. So what you're talking about that is that contract can only be exercised on that expiration date, which might be part of the reason why hedge funds, institutional firms, et cetera, professional traders, maybe that's a reason why it's I don't want to say so attractive to them, but is it possibly a reason why they're attracted to the product?
Yeah. Oh, definitely. So, one of the things that is attractive is, being able to manage that position. Mm-hmm. So there is this element of not having to manage it the same way you would if you had an option that you could be assigned on at any point during, that time period that it's going to exist, which is one of the things that happens with an American style option. Mm-hmm. So with these indexes, you don't have to be concerned about that. But the flip side of that, if you wanted to get out of the position, you would have to close the option prior to expiration.
Right. Okay. And when we're dealing with broad-based indices, so obviously there's different indices. There's narrow-based, which might be a sector like, the tech sector, healthcare, transportation, something like that. Broad-based, where it is more encompassing of the market as a whole. You had mentioned the S&P 500, for example. For my part, I'm thinking that you've got less, and I'm not quite sure how to phrase this, but maybe less specific risk or stock-specific risk. If you're buying an ETF or an equity option on an underlying stock, obviously you've got specific risk to that stock or ETF. Because the index is an aggregate of a wide variety or a wide number of securities, that individual stock that's in that ETF maybe not have as much impact on the index as a whole. So I guess what I'm getting at is, could it be seen, or do people think that indices as a whole are maybe less volatile or subject to volatility as opposed to a specific stock?
Yeah, so they don't have the same kind of volatility concern when Tesla is having earnings, right? Because it's not going to impact, the index the same way it would impact, trading Tesla. That being said, these indices generally could be impact for global reasons, global impact, whether that's a war or that's just, the an election. So you might see some volatility in these kind of products for the global reason, but it's unlikely that you would see them for an individual stock that's going through earnings.
Right. So I guess I'm looking back to my economics days back in college, Econ 101 and 102, macro versus micro. I guess you can kind of look at the index more of a macroeconomic or from a macroeconomic perspective as opposed to a micro. I remember one of my economics professors talking about macro is the forest and micro is the trees within the forest. So maybe that individual equity or ETF would be the trees and the indice as a whole might be the forest, something along those lines.
Right. So if you're looking at, the S&P 500, right? So it's a forest,
right.
Per se, of 500 trees. Right, versus the individual trees. The same way if you're looking at the RUT, right, which is more the small cap, but it's 2,000 of those small trees, to keep using the metaphor. And then you have the NASDAQ, which are pretty much domestic, top 100 stocks. So each one of those have different characteristics, but the big impact comes from either, domestic news or global news that's going on. That's where you kind of see that risk. And so a lot of people will trade these indices to protect them from these global impacts that are going to happen.
Right. Okay. And it's interesting that you bring that up. So when I started in the business, and I think you and I got started roughly at the same time, there was pretty much the monthly expiration. Third Friday of the month, it was a big deal. Couldn't take any time off during that period. I remember I had to plan my wedding around expiration. The reason I bring that up is the exchanges began to introduce expiration dates aside from that third Friday. So now we've got weekly contracts that first were expiring on Fridays other than that third Friday. Then Monday weeklies, Wednesday weeklies. Now we've got Monday, Tuesday, Wednesday, Thursday, Friday. So there's now expiration every day. But the reason I mention this is because that fine-tuning of those products or that the exchange launched in terms of expiration dates really sprang from the demand of institutional investors, professional traders, et cetera, trading indices, right? They wanted to be able to have a contract expiring, daily as opposed to just once a month. So the indices, one of the differences, again, versus the equities and ETFs is the frequency of expiration dates, right? And now, as I had mentioned, there's daily expiration. So certainly something interesting. But don't they also have different trading hours versus equities?
Okay, so that's a good point, Mark. So we do have a difference, but a 15-minute difference between when equities and these ETFs stop trading each day and when these indexes stop trading, which is one closes at 4 Eastern Standard Time, the other one 4:15 Eastern Standard Time. Another very significant difference is when you see SPXW or RUTW, when you see a W, those are our weeklies, right? Those weeklies all expire at the end of the day. But if you see an SPX or an RUT or an NDX, all of those are the regular, expiring third Friday of each month, and they have those AM settlements, which really gives you that overnight risk that happens with them. And so that's something to be aware of. So when you're looking at those symbols, be cognizant of whether or not that symbol says RUTW or does it just say RUT? And if it says RUT, you know that that's an AM settlement, and that's pretty much across the board for these, especially these indices that were the original indexes that were traded back. Right.
And for the contracts that are AM settlement, the last day to actually trade the product to close out a position or open a new one, what have you, is the day before. So if you've got a third Friday of the month contract AM settlement, it's going to settle on that Friday morning print but the last day to trade it is that previous Thursday. Right. So just like any other product out there, whether it's equity, index, or ETF, know your product, know the parameters, know the structure, and just know the specifications. So definitely be familiar with that. So excellent stuff, Roma. I certainly appreciate that. Very much looking forward to a more in-depth discussion and presentation that you have for your 2 December OIC webinars. While I still have you here, I got to tell you, Roma, I am immensely impressed at the feedback that I hear and the content that I see for the university outreach program that you're doing. I'm hearing great things about it. The videos that I see, the photos that I see, and reviews that I read about it. An absolutely wonderful program. Why don't you tell us a little bit about that and how that works and what the purpose is?
So this is something that OCC, OIC, our team is super excited about, and that's really getting our young, future financial leaders educated about options. Now, as we know, since COVID, we've seen that huge increase in volume. Now, part of that is a lot of young people trading. Now, we filled, as Mark knows, we get a lot of emails from these young investors that are asking why they didn't make money. Because they're reading something about, even as simple as a reverse split, and they can't figure out why they bought an out-of-the-money option, and now the stock is trading above that, and they're not making money. So we're spending time teaching them, and we thought, you know what, we got to go back to the ground floor and go to these universities and start giving them education that they need, because not all of them are going to necessarily become future traders and trading volatilities, but all of them can be smart investors, just like many of our investors that are listening to this. So we're at the ground floor going to these universities. Last week we were at Indiana Institute of Technology, taught a class there. Those kids were fantastic, and they just absorbed everything that I had to present to them. And that includes how our industry works. How do options clear? What is the role of the OCC?
Right. Definitely something that your average investor, I don't care how long you're trading, probably not very familiar with. So certainly a great start for these people.
And I have to be thankful to all these universities that are so welcoming. They understand the need of giving these financial students this kind of education. So it's been well received. The team that's working on it has been excellent, and we're, on the phone and sending out emails to these professors, and they're all like, can you get here next week?
Yeah,
so it's been super exciting.
That's excellent. I can certainly see how excited you are about the project, very passionate about it. And like I said, I've been hearing wonderful things. So congratulations on resurrecting something that kind of went by the wayside for a few years. So absolutely wonderful. Let me ask you, Roma, time's about running out, but also the year is running out as well. So with the holidays coming up, any special plans for the holidays? Any New Year's resolutions? What are you thinking?
So special plans for the holidays. I have my daughters coming in, super excited about that. New Year's resolutions. I completely failed last year at my New Year's resolution. So there will be no New Year's resolution.
That's your resolution, to not make any more New Year's resolutions? Exactly.
I'm kind of done, at least for this coming year. But I do plan to do things that will just better me.
Excellent.
Let's just say that.
A better you. I love that. Roma 2.0 for 2024. I love that. That's excellent. Sounds great, Roma. And best of luck on Roma 2.0.
Thank you.
Well, Roma, let's go ahead and kind of close things out here. Thanks again for joining me in the studio today. Thanks to all of our listeners and supporters out there. As always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. And be sure to register for Roma's 2 upcoming December presentations. You can find that registration information on the events section of our website. That being said, thanks again to all those listening. Roma, thank you for joining me. And for all of us at OIC, we wish you a very happy holiday season and a happy and healthy new year. Take care, everyone, and we'll be seeing you again very soon.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.